Hello, in this lecture we will define relevance principle. According to Fundamental Accounting Principles, WOW 22nd edition, the definition of relevance principle is information system principle, prescribing that its reports be useful, understandable, timely, and pertinent for decision makers. This would seem like a fairly intuitive principle, but it is important to note, it is important to keep in mind, we are looking at the financial statements generally, or the information for the end users, those end users being the decision makers. That means that this information needs to be useful to the end users. It needs to be understandable. It needs to be timely, meaning we don't want really old information that makes it less useful, and it needs to be pertinent to the decision makers. We can think of the relevance principles as one of the core principles of the accounting information system, the system in which we are creating that data, inputting that data, and then processing that data and putting it into relevant form, usually financial statements. Other principles we have to think of at the same time in terms of the big picture would be the controls. We have relevance, which we're concentrating on here, compatibility, flexibility, and cost benefit. We need to think of these in conjunction with each other as we think about the accounting information system. We can imagine with relation to the relevance principle and end users, such as a banker here, we're imagining that we are the business. We've created the financial statements for the end user being the banker to decide if we want to have a loan. And we can imagine some of the questions that would go through the banker's head here. The idea of the loan being that the banker wants to give a loan if they can receive interest and payments on the loan, but question is whether the interest and the payments can be paid back from the business. That's what the need of the financial statements, that's why they would be relevant to the banker, because that past history, that point in time of where the financial statements are, balance sheet, and the performance of how the financial statements, how the business has been doing over the last time period, the income statement will be relevant to future ability to pay. So our banker would also have to think about, can we trust this information? And so that means that trusting it would be that, is it in a format that is useful to the end user? And usually that format is going to be in terms of generally accepted accounting principles. Clearly it needs to be timing related. The banker's not going to want financial statements from 10 years ago, possibly, unless they're doing a very in-depth analysis. They want more recent information, that information being more useful. It needs to be understandable to the banker. That probably means banker's going to want it in forms of maybe a tax return, more likely going to be generally accepted accounting principles, and possibly even need an audit or a review for those. And of course, it needs to be useful to the decision maker. Are those financial data, in this case, useful to the decision maker here deciding whether to give a loan to the business?